Welcome to the podcast. I'm Herb Alston. Finance can be messy, but we clean it up with a little sarcasm and a little humor, and hopefully you'll learn something today. Don't forget to like, subscribe to the podcast by tapping the icon below. My guest today is Joe Viery. And I find Joe's background and work really interesting. And he's in this area of cost segregation. And sometimes when you say cost segregation, I think even CPAs roll their eyes. Um, so I want to talk to you. I want to talk about the basics, right? But I really want to get into people start looking for the nearest exit, right? When you start talking segregation, but what you've built is around making this strategy simple enough that real estate investors can actually use it. Can you talk a little about that?
Sure. Thanks, Herb. I think that for the average person and even accountants, CPAs, they really don't get too much involved in depreciation. Some of them aren't even real estate accountants, so depreciation is kind of something that they want to take the easiest way out, and the clients want to take the easiest way out. The easy way of doing it is simply derive the building basis, which is very simple. What you paid for the building, not what it's worth, what you paid for the building, the money that came out of somewhere, finance or cash, whatever, and then deduct the land because land is not depreciable. And if it's residential, you can have your children do this, divide by 27 and a half, or if it's a commercial building, 39 years. That's how everybody does the easiest way to depreciate. The IRS says, no, that's not the way you should be depreciating your buildings. And all I need to do is if somebody's in a residence, like let's say they're in their rental property, and I point down and I say, is that carpet going to last 27 and a half years? They say, are you crazy? I'm lucky if I get 5 years out of my carpet. My tenants beat the hell out of the apartment. So bottom line is the IRS has hundreds and hundreds of these components that they put into shorter lives. All this means to the average person is when you have a shorter life asset, that means in essence, when you combine it with the stuff I can accelerate, you get a big bump in your expenses for the year you do the study. That's all cost seg is simply an acceleration of your expenses, and everybody should know the basics. When you have gross taxable income, the more the expenses are, the less you're going to pay in income taxes. That's all cost segregation is.
So when you tell someone at a barbecue that you do cost segregation, how long does it take for their eyes to glaze over? Is it like 7 seconds or 12?
Oh my God. I'm dealing in the world. Get this. I'm dealing in the world of IRS. That'll put you to sleep immediately. Right. I'm dealing in the world of taxes. That will put you to sleep pretty quickly. Plus, we're an engineering firm, and if anybody knows engineers, that'll put you to sleep very quickly. So that has been a problem since I've been doing this since 2007. But we try at USTAG, U.S. Tax Advisors Group, we try to make it simple and just go through the basics. I treat everybody until I know who they are, like I'm talking to, a 6-year-old, an 8-year-old, just to make it really simple. I don't talk about IRS code or anything that's going to get them off track. I mean, what I basically explained in the beginning is all it is. I'm just giving you more expenses. And if you know the basic principle, the more expenses, the less you're going to pay in income tax. That's all you need to know. The only question is, are you a viable candidate? And then by the way, most investors are. There are some that aren't. And what we do is we try to make sure the ones that aren't, I'm not wasting their time and they're not wasting my time. So we explain to them, hey, we don't think you're a good candidate. So, there's nothing else to be said here. And we cut them loose and tell them, that we can't help them.
So I want to go back to your origin. Take me back before USTAGI, right? What did you see in the real estate investment world or investor world that made you think there's a real problem here and I can solve it?
Well, basically my background is I started in 2000 working for the California Association of Realtors. And I was in the financial team, which worked with real estate agents and their clients and how to solve tax problems. So that's my world, is basically tax problems. When I worked for CAR, I was involved in more or less capital gains taxes. Nobody even knew about cost segregation back in those days. It's been around a lot, like before they call it component depreciation. So the concept's been around, but there was a court case in 1997, and that kind of jump started the way the current industry is surrounded. So back in my day, as you know, up until 2008, what was going on in real estate? It was booming.
Yeah.
So yeah, I mean, all people were interested in is, hey, if I sell my property, how the heck am I going to avoid paying taxes? And they didn't even know that there's any strategy, or very few that could put a dent in their income taxes, which is my world. So what happened with me is that I didn't have these problems until the car fell off the cliff in 2007 and 8, and I had already done a couple cost segs. And so in 2008, that's when basically the car membership was cut in half. So I had no choice but to look elsewhere. And the company that I did the cost seg for called me up and said, "Hey, look, you're great at this. Why don't you come on board and bring your skills to our clients?" And so I made the jump to cost seg. And then in 2016, I started my own business.
Okay. Wow. Was there one client, one deal, one tax return when you saw the light bulb go off on this?
No, it was my first ones. I mean, I was like everybody back in those days. The number one word was scam. Oh, this can't be true. This must be a scam. I mean, now I'm talking about, I'm saving my clients hundreds of thousands of dollars. So everybody would say this must be a scam. Today, that is not the case. Every accountant should at least know how to pronounce cost segregation. They may not understand it 100%, but everybody should know about it. Investors, it's another story, because a lot of investors give it to other financial people to handle it. They don't know about cost seg, so they're missing the boat. And they don't know that there's a company out there like my company that can even work with the smaller buildings, the buildings with a basis of $1.2 million and less.
When you first got into this, did you feel like you were selling a tax strategy or teaching people to think differently about ownership?
When I first started, the one area that attracted me is that rather than selling a product, I was actually selling people money. I was saying, look, you have a choice. You can either write a check out to the IRS for $150,000, or you can keep that money in your bank account. And so that is what really attracted me to cost segregation. Back in the dark days, though, it was an educational process because everybody was so skeptical. They thought it was a trick. And if anybody wants proof of what I'm talking about, it's really simple. Just Google ATG, or Audit Technique Guidelines for Cost Segregation. Look for the site on the IRS website. And basically, there's a 400-page document. You can read all about cost seg, the rules of the road, and that's what my company follows. We follow the ATG, so we do everything compliantly. And so our job is really to just get the client over the hump and explaining this concept, how it works, how they can use it if they're a good candidate. And so a lot of what we do is education.
So go back and give us that site again.
My website?
No, the location of the information, the ATG.
Oh, I'm sorry. It's ATG, that's abbreviated, but it's the Audit Technique Guidelines, ATG, for cost segregation. Just Google that. And the first thing that pops up should be the IRS website. If there is an ad, maybe the ad might be like another tax provider, cost seg company, but just make sure you're going to the IRS. And basically, if you can't sleep at night, print that out and start reading it.
Let's go into explaining cost segregation, okay? As if you were talking to a successful real estate investor, right? Okay. Who might be smart, but they're busy and absolutely does not want a tax code lecture.
Right. Like I said, it's very, very simple. All we're doing is we're accelerating their depreciation. And so what we're doing as engineers is we're looking at the building, and we find all of the components of the building, items that were built when they constructed the building, will qualify for shorter life assets. So I can name some of the easy ones. I'm looking for carpet. I'm looking for window coverings. I'm looking for specialty items, specialty electrical. I'm looking for, in some buildings, cabinets and countertops, molding. All of these items on the interior building will qualify for 5 or 7 year. And then also furniture, fixtures, but most of the time, their accountants should know how to qualify in a shorter life their furniture and fixtures. But we do that if the accountant doesn't know how to do that. And then we look at the outside of the building, which is going to be in a 15-year category. And the 15-year category are land improvements. They're going to be items like driveways, swimming pools, hot tubs, patios, landscaping, fences. And basically what we do is we do not take all of the depreciation and accelerate the items. And I'll just throw out a number. It's different for every building. So keep in mind when I'm throwing this number out, don't take this to the bank. 30% of the building basis, about. It's going to be a little bit less for single family homes. It'll be more for senior living, for commercial buildings like hotels and offices. It's going to be more. It's going to be in the 30%, but let's say 30%. So all we're taking is, if you've got a building basis, again, what you pay for the building, less improvements, that's the basis, and you take off 30%, that is the kind of expenses we're giving you the year you do the study. The other 70% stays in 27 and a half years. So one of the objections were some accountants in the dark days would say, well, why would I pay you? Why would anybody pay you so you wipe out all the depreciation expense? The answer is we're not doing it. We're just taking out that 30% that we can accelerate, legally, compliantly accelerate. So basically, you've still got 27 and a half years of expenses. The only thing is you're not getting as much as you would have, but everybody should know the time value of money. If you're an investor, the time value of money is very simple. You want your deductions today. You don't want to wait 27 and a half years for your deductions. So that is the power of cost ed.
So you've kind of answered my next question, because most investors understand depreciation in theory, right? But they don't understand the power of timing. Why does timing matter so much? I mean, I think you've answered it in a way that you're getting it right away.
Well, everybody should know this, but I take that for granted, and maybe some don't. It's the time value of money. Basically, $1 today is, well, let's go back. How about now with what we're going through now? Let's go back 10 years ago. Do you think your dollar 10 years ago was more powerful than your dollar today? Well, heck yes. I mean, we're just getting eroded by inflation and all of these economic pressures. So it's not hard to understand. Your dollar today is worth more. So you want your deductions today, because your deductions today are worth a heck of a lot more than if you wait even 5 years down the road. And so that is it. Oh, and by the way, this is a really good lesson too. Somebody, when they used to think it was a trick to accelerate your depreciation, I asked them, I said, well, if you do straight line and you do accelerated depreciation, after 27 and a half years for a residential building, how much depreciation will you've taken over the 27 and a half years? Well, they think, oh, I got a lot more with accelerated. No, it's the same. No. All we're doing is it's timing. That's all we're doing. And I would like you to take the money I save you and invest it in something. But you can go to Europe, you can go, you can buy a boat or whatever. But my theory is, if you're in real estate, the money I save you, and buy more real estate or improve your real estate. But that's all it is. It's the time value of money that makes $1 today worth more than down the road. So you always want to take your dollar today.
Where do people get into trouble? Is it bad assumptions? Is it bad providers? Or is it a bad CPA coordination, or just by waiting too long?
Here's, you might be asking me this down the road, but I always, I speak across the nation and virtually quite a bit. And the question will come up like, what's your number one tip? What's your number one kernel? My number one tip, and I strongly believe in this tip, is if you're going to invest in real estate, you want to get people who know real estate. You want Herb who knows 1031 exchanges. You want to know a good realtor. You want to know a good accountant. You want to know a good attorney. The reason why, the number one reason is you want a good accountant, because if your accountant has a portfolio of clients that basically they mostly all work for Costco, they don't know real estate. They have a hard time with knowing, and the reason why investors invest in real estate, there's a lot of reasons. I'm not going to get into them except for the one I'm in, and that's taxes. It is the most tax advantage investment that you can place your money in. So bottom line is you need people who know real estate. That's my number one tip. Don't do the accountant that has a bunch of people that work for Costco or retail, because you want to find somebody who knows. Now you may pay more, but you're going to save more money. It'll be a big win for you down the road. Not immediately, because usually real estate savvy CPAs, accountants are going to cost more. That's my number one advice to everybody. Find people who know real estate.
So what I hear you saying is people get into trouble because they don't get an expert who really knows the space to really help them. I work with a lot of car wash owners, and that is a really complicated transaction. And a lot of times I have to say to people, look, you can't just go to a realtor who sells single family homes and ask them to sell your car wash, because there's so many different pieces. It's the same thing. You don't get a dentist to do brain surgery. So this isn't magic. I mean, it's not a loophole in the shady sense.
Nope.
It's more like the tax code saying, if you own the asset, you know what you own. Know what you own. Is that fair?
Correct. Yes.
Yeah, exactly. Who is the perfect candidate for a cost segregation study, and who is not a good candidate?
You know what? There's only a few. I love that when I talk. This is my most favorite, because I try and distill it, because very, very few investors are not good candidates. But the number one has got to be an investment real estate. It cannot be your primary residence. So that's out. So if you own a home and you think you can accelerate depreciation, there is no depreciation on the real estate you own. Number two is, this sounds flippant, but you must pay income tax. People get so excited about accelerated depreciation. When I ask them, well, how much tax do you pay? They go, well, I don't pay any tax. Then it's like, no, you don't need to call Joe. You only call me when you meet with your accountant and they say, write a check out for X. That's when you call me, because I can keep that money in your pocket. Number two, we talked about this earlier before, are flippers. Flippers are not a good candidate. Because it's the time value of money. You're going to pay me a fee, and then I'm going to save you this boatload of money. You need to do something with this money, because there is a concept called depreciation recapture. Even though cost segregation reduces depreciation recapture, you got to have a little bit of time. Talking all over the country, my time period is 1.5 years to 2 years. If you tell me you're a flipper or you're not going to hold the property for 2 years, I say don't bother doing cost seg, because you're gonna have to pay it back, and I say don't even bother. Now, if you want to do it, I will take your money and I'll give you the report, but I will make the caveat to the client, hey, be careful. The other part is 1031 exchanges. We do a lot of work with 1031 exchanges. However, it's not guaranteed. It is something that we're going to have to get the smarter people in the room to decide if there's any value in it. So there are times, probably I'm going to guess about 30% of 1031 exchanges are not going to be good candidates. The reason why is because when you sell the building, when you relinquish the building, you've already been depreciating that building. So all of that money you bring over, I can't look at. You're already depreciating. It is locked into that method, which is straight line, forever. So I can't look at that. So then you have to make sure you exchange up. If you exchange even, I have nothing to look at. Or if you exchange for $50,000 more in building basis, well, it's not worth it to pay me. I'll tell you, don't do it. Don't bother doing it. And then the last one, which is probably the most important, are the passive active investors. If you're a passive investor, I would advise you to try and become an active investor. And all this means is there's limits to passive depreciation expense. It's $25,000 maximum per year per entity. If you have a single family home, that still can be plenty of money to work with. It may take you 3 years to get my $75,000, but that's a moot point. So a lot of passive investors, but if I give you $2 million and you can only use $25,000 a year, I'm going to tell you, no, do not look at cost segregation. Right. So that's the one that can make it. It's the most important reason why I would tell somebody don't do it. And there are ways around it. There are certain tricks. There are certain strategies where you can get around it. So it's not the end of the world if you're a passive investor. What you do is call me and I'll tell you what I think and if there's a way around it. Legally, of course, there's a strategy around it. Like one strategy right now are short-term rentals. I won't talk about them, but there's an exclusion of short-term rentals that makes them advantageous to becoming an active investor. And what this means, if you're an active investor, it means that every dollar I save you in or I give you in depreciation can be used against any and all your income. For passive investors, it can only be used in the real estate bucket. You can't use it for your wife's salary. Can't use it for your salary. You can only, and so if your real estate is not creating any taxable obligations, then I will tell you, you're probably not going to be a good candidate. But short-term rentals, there's an exclusion, and that may work. So there are strategies that might work if you want to invest in real estate, and if you want to be an active investor, which everybody should want to be, there are strategies.
So if someone owns a $500,000 rental versus a $5 million multi-million dollar multifamily building, how does the decision-making differ?
Well, again, it goes back to active passive. If you're an active investor, it just means the $5 million building, I'm going to save you hundreds of thousands of dollars, if not over $1 million in income taxes. For the smaller building, you have to look at my fee. And this type of study we do for the smaller buildings is called an analytical, or we call it a modeling study. And I've been doing these for many years, and we've kind of, we're on the forefront of developing this technique. There's not very many cost seg companies out there that will look at smaller buildings, or if they do look at them, they'll say it's $3,000. Our fees are under $1,000 to do that $500,000 home. So the idea is take my fee and look at how much money I'm going to save you to determine. If you have a $5 million building, forget about it. It's many times the fee. But if you have a smaller building, you have to look at that. So let's say on that $500,000 building, I'll just do this real quick. And let's say that you have 20% land. So basically what we're looking at is $400,000. And this is just a strict, we're very conservative when we give an estimate. We don't charge for the estimate, but I'm going to tell you, I'm going to find you $88,000 in additional depreciation if you accelerate it. And if you want to know how much money I'm going to save you, that's your deduction. That's a function of your tax rate. So if you live in California, for example, I can tell you that's a 40% rate. So that's state and feds. So basically, if you times that by 40%, that means I'm going to save out of your bank account $35,000 minimum is what I'm going to save you. So now you have to look at my fee. Let's just round it up and say $1,000. Is it worth spending $1,000 to save $35,000? I think the answer is yes.
Yeah, absolutely.
And that's the only thing you really need to look at.
Yeah, exactly. What is the coordination points between the CPA, the qualified intermediary, the cost segregation firm, and the advisor?
Well, definitely, and here's one important point. We do not create the numbers. We have to use what the CPA, the accountant's going to use. We have to use their numbers. So for example, I'm not the one that comes up with the land allocation. That 20% I threw out for the $500,000 property, that's up to the accountant. I can give you my advice. I can tell you what I think, but that's not up to us. That's up to the client. And so bottom line, it's a partnership between all moving, the intermediary, the accountant, the cost seg team should all work together and to try and figure out, number one, is this going to be a viable property to look at? And number two, who's involved, who's in charge of giving me the information I need? From the intermediary, I'm going to need to know what basis. Well, I might need the basic information. How much did you bring into the building and how, the acquisition, and how much did you buy the new building for? So that's just the basic information. Right. But then we also have to look at all the other nuances that go with 1031 exchanges, which you could help me with. And then the accountant is the one that's going to have to apply my results. So I'm not the one that applies the tax return. I'm not an accountant. So I have to work with the accountant. And usually what happens is once I work with the accountant and they know there's a company out there like mine, then the light bulb goes on. And now they're all in favor of cost seg. And of course, I get a boatload of referrals from my accountant partners. Right. But basically, we all work together. It's mandatory. If we don't, then I basically can't do my job. And I probably would not, I'd pull the plug and not work with that client.
It's really, to me, a lot of times it's staying in your lane. And that's a lot of what I have to talk to clients about. And I have to say, look, my role is here. The QI's role is here. The CPA has a completely different lane. We're all going to help you, but we're all working together to get the train down the tracks. Where do people accidentally create tax inefficiencies because people aren't talking to each other? Where do they screw up?
Well, I actually can only look at my world, which is the world of income tax. Again, I hate to do this, but I'm going to throw that out again. It's if you don't have the right accountant, then basically that's the biggest. If you have the right accountant who knows real estate, they're the ones that should answer that question perfectly. I only deal in accelerated depreciation, so I'm really not the one to ask them. But that's key because there's so many tax advantages to real estate. You know, as everybody knows, because of all the expensing opportunities. There's just tons of strategies out there, and the one who can even though maybe they're not a financial planner, but they're the ones that should know how to call Herb, the financial planner, to answer that question. So I think they're usually the number one quarterback. They will call in the Herbs and the Joes of the world. So find a good one.
Yeah. This is why I keep telling my clients and advisors, buying another property is not your only option, but whatever option you choose, you need the tax strategy to match the life strategy. Right. And it's always the conversation I have. You've completed thousands of studies. At what point did this become more than a technical service and become a mission to you?
Well, I hate to go back this far, but I think, you know, when the light bulb switched and I decided to get in this industry full time. So I'm talking about 20 years ago is when it switched. And y'all talk about stories. I got a little help from whoever. If you're a spiritual person, you might say, you know, the answer, the supreme, you know, the universe or whatever. But basically, I knocked on a door of a small hotel in San Diego. It was a Comfort Inn. And the guy was really busy behind the desk. I said, "Who owns this building?" And he goes, "Well, I do." And I said, "Well, this is what I do." And he goes, "Oh, no, I don't pay income tax. Go away." So I went away, and I get a phone call about 6 months later, and he goes, "Joe, this is me again." He goes, "I have a situation. I'm wondering if you can help me." And this was during the Depression. So basically, he did not have any money. He refinanced with Wells Fargo, and that created a $125,000 income tax bill. And he goes, "I had great news. I refinanced. It's a great rate, but now I owe 125. Can you help me?" And I said, I can. And so he paid half of his fee. And then when it came to paying the other half, and by the way, I wiped out his $125,000. And then when it came to the other half of his fee, he goes, well, guess what? I can't pay you. I can't pay you. But he says, one of my best friends is the gentleman that owns this company. And have you ever heard of him? And I said, no, I've never heard of him because, until I got involved in cost seg, I didn't know, anybody who was a real estate investor. And this was right in the beginning. And so basically I walked in the door to the largest real estate developer in San Diego. And that was pretty amazing because there was no selling. They just said, hey, we know we should be doing this. Why don't you sit down and help us and tell us what you can do? And I just walked into that. And I've done hundreds and hundreds and hundreds of their buildings. They own billions of dollars of real estate. So that's a funny story in itself.
When you're dealing with someone's taxes, there's fear, there's skepticism, and there's sometimes embarrassment. How do you lower the temperature?
Well, I think what I tried to have my team do is to be honest in all ways, shapes, and forms. That's why when I tell you we have to let the people know when they're not a good candidate. And I think by presenting that honesty is that we try and when it comes to income taxes, get them comfortable enough that they would give us their tax return. Because a lot of people are very uncomfortable in sharing their tax situation, and there's no judgment on our end. Obviously, you better be paying income tax, but we don't care how much you owe in income tax. Our job is to help you mitigate that and reduce it. But I think by being honest with our clients that we can kind of mitigate that where, we tell them that the only way we can help them is if we know the honest truth from them. And one of the ways is to know, what is your tax situation? The good news is if you don't pay any income taxes and people are embarrassed when they don't, that's not a problem. I just tell them, one day you probably will. That's when you call us.
I'm a big fan of Jesse Itzler. I don't know if you keep up with Jesse. He's got a great podcast. He always talks about building a life resume, not just a business resume. What has building this company taught you about endurance?
Oh boy. Obviously the one kernel of truth is to never give up, no matter what. And there have been in my career at cost seg, there have been ups and downs. And of course, the last couple of years have been unusual because they're not like what happened in the past, which was straight up. But even for us, because I have a good base of clients that they may not be buying like a lot of properties, but they're always buying properties. That's one thing a real estate investor will always. By the way, mine, Herb, is a one and done. So once you do cost seg on a building, I don't need to see the client unless they buy another building or they make an improvement on a building. I can do cost seg on improvements too. So for example, restaurants, they usually don't own the building. They usually pay for the improvements. And sometimes they're millions of dollars to build out a restaurant. But normally I'm a one and done. I do the report. But I think that that's the number one thing is perseverance, is that business is hard and life is hard, and keep focused and just don't give up.
I heard you kind of take a little turn when I asked that question. And was there a season where the business almost broke you or forced you to grow faster than you wanted to?
No. The last couple of years, it's been a little bit tough for many, many reasons, but that I never felt that I was anywhere near impending doom or anything that was going to tremendously adversely affect my business. I just knew that times were going to be a little bit tough, and I had to improve the operations of the building and my overhead. And so that's what I've been on the path the last couple of years. As everybody knows, AI. But in my industry, AI has been incredibly important, and it has helped me increase the quality of my studies. But it's also decreasing, of course, my overhead. So that's been a challenge because I'm not an AI person. I'm an old dog. I don't like new tricks.
I've got some rapid fire questions for you.
Sure.
Real quick answers. Most overrated tax myth.
You should always pay some income tax.
Most underrated real estate tax strategy.
Cost segregation. No, that's really true. I mean, really seriously, even in this day and age, that's true.
The property type where investors are most surprised by the cost segregation result.
Single family homes.
Do you want to talk about that just a little bit? Because my audience probably has rentals and people own rentals. Can you share a little bit about that?
Well, they don't. Most single family home investors don't even know you can do cost seg. They don't know there's a company like me. So when they get involved in me, and I do them with me, and I do a cost seg for them, and the light bulb goes on, and they go, "Oh my God, you mean I should have been doing this for the last X years?" I go, "Yeah, you really should have been doing this." Well, they didn't know that I existed because, like I said, we can do it and make it affordable because my competitors charge thousands of dollars when I charge under $1,000. So that's a shock to them. They've always been told by their accountant, "Oh, you're not a good candidate for cost seg because it costs that $3,000, and that'll never be a good value proposition for you." Yeah. But when they work with us, they figure out, hey, they're paying under $1,000, and they get, like I just mentioned on the simple, acquisition, $33,000. For the small single family home rental investor, that's a lot of money.
Yeah. Oh, yeah. Absolutely.
Yeah.
All right. Back to my one sentence questions. Okay. One sentence every CPA wishes investors understood.
Yeah. The CPA wishes the investor. It's definitely not the time value of money because accounts are the worst of the time value of money. They don't get that concept because they're not financial planners. They're people who fill out paperwork and file tax returns, believe it or not. And so, you stumped me on that one.
If cost segregation were a superhero, who is it?
That's classic. The problem is, my kids are all grown and I don't even know the superheroes nowadays. Superhero. Give me an idea. What are you thinking of a superhero? Like Mighty Mouse, Superman?
Or Spider-Man, right?
Spider-Man.
This big, he's got a movie coming out. So, all right, we'll pass on that one.
Okay.
Let's go to this one. If depreciation recapture were a movie villain, who would it be?
I love you in movies because I'm a movie freak. A movie that's depreciation recapture, a movie villain. Yeah, boy, you're stumping me there, Herb. I need help with this. I gotta get a young involved to help me with this. But I go back, like I said, I love any genre of movie, and I'm just trying to think of a movie villain. So I draw a blank. So next.
All right, we're gonna keep going here. Tell me one mistake that makes you want to gently take the investor's calculator away.
Not developing an understanding of what they're investing in. They just really, mom and dad owned rental properties. Mom and dad never taught them any of the principles of economics or investing in real estate. Today, there is so much information on the web. There's so many real estate groups. There are so many workshops, masterminds. I advise everybody to find a real estate group or a mastermind, because now you got a cadre of like-minded individuals. Because to be a successful real estate investor does not take a lot of brain power, but it does take a lot of knowledge. You got to load yourself up with knowledge and figure out, what all of these mean. Like cost segregation, what does that mean? Why would I want to look at cost segregation? And like the financials side of it, the 1031 exchange side of it. You don't need to be an expert, but some of the clients, they don't even know how to spell depreciation. They're completely lost. And I would want to throw their calculator away, burn it, and say, why don't you just go and invest in stocks and bonds?
Right. It's an interesting way to think about it, because I deal with realtors all the time, and I have to tell them, you don't have to be a 1031 exchange expert. You should just stay in your lane. But what you want to do is to say to a seller, I'm not trying to sell you anything. I just want to make sure that you have an education on every option out there for you. Yeah. Right. And that's the conversation I always have with realtors who are dealing with investors. What should every real estate investor ask their CPA before the end of this year, before December 31st? Is there a question or something that investor should ask their CPA about? Cost segregation, but
yeah, no. I was, believe it or not, I wasn't going to go there. No, I think that basically, again, well, this is kind of after the fact, but I mean, assuming they have a good accountant, I think they should ask them about any and every strategy that can help them and to achieve their goals. Push the envelope with the accountant and make them, try and figure out that they're going to stay in real estate. They're a real estate investor, and the rest of this year is, guess what? That is the time you want to plan for the tax season next year. We're wrapping up 2005. Only people on extension. There's a lot of them, but once that September 15th, October 15th, it's over with. So if you've already filed your taxes, use this time to figure out next year. Don't call me if you're going to file March 15th. Don't call Joe, on March 1st or on, February the 15th. So you should be talking to your accountant. You should sit down with them and say, look, help me plan this out. If you don't know any of the answers, give me a recommendation. Tell me how to get a hold of Herb. Tell me how to get a hold of everybody out there that can help me.
If someone listening owns investment real estate and suspects that they may be leaving money on the table, is there something they should do first? Should they be looking at the expenses? What do they do to even get ready to have a conversation with you?
Number one is they should have a good understanding of what they bought. Now that might sound silly, but let's say they bought a building in 26. They bought it in January of this year, February of this year. Before they call me, they should know exactly what I'm going to, the answers to my questions. Okay, I need to know. It's very simple. But a lot of investors are very lame on this. Number one is know what you bought. You do not have your accountant involved at this point. Accountants usually don't get involved until right before you file. So they're not going to get involved in this property you bought until, let's say, if you're March 15th. By the way, March 15th is for entities filing, and most of my clients own their properties in entities like an LLC or an LP. And so they're March 15th. That's why I threw out March 15th, but it could be April 15th if it's a sole proprietorship. But basically, they need to know, like they don't have their account. They need to be able to tell me the answers, but they should already know this. Okay, how much did you pay for the building, and what date did you close on the sale of the building? And they need to know the basics. And then they also need to know, and this is the tough part, they should really focus on keeping good records. I talk to a lot of clients and they say, oh yeah, I spent about $110,000 on improvements. Well, what'd you do? Well, we did the usual stuff. I go, well, I can't use the usual. I need on a piece of paper what you did on your improvements? Did you buy new cabinets? Did you buy new carpet? Did you do new landscaping? Did you do new, what did you do? And a lot of investors, especially when they're first starting out, that's one of the weakest points. So just keep good records, because you never know when a cost seg guy is going to pop up and ask you what you did, but your accountant's going to want to know that information when you get to tax time too.
Right. Did you redo the plumbing? Did you put solar on the roof?
And a lot of people don't even know. They have, I paid this guy to do it, and he did it, and he just fixed it all up. And I'm going like, well, yeah, but I can't tell the IRS you just fix things up. I got to tell the IRS this is what you did, and this is how much you paid on it for
it. In some ways, cost segregation sounds like something that happens when accountants are left unsupervised. Most investors know their cap rate, their rent roll, their interest rate, but they don't know what's hiding in the walls. This is what we're talking about here, isn't it? I mean, it's really getting into the nitty gritty.
Well, if you read the ATG, the Audit Technique Guidelines published by the IRS, their number one standard of excellence is having an engineer. And that's one thing what separates us from another cost seg company, is that they're construction engineers, basically, is what we have. And so bottom line is, I see a lot of times accountants do a feeble job at trying to accelerate. Number one, they're not engineers, so they're going to get hammered by the IRS. Number two is, you're right, they don't know what's behind the walls. They don't know how to read plans. They do not know the IRS rules and regulations for cost segregation. So I see a lot of times accountants will try to accelerate. Now, some of these are very, very simple. Some of the items, like for example, furniture. You don't need me to know that furniture is 5 years. Every accountant should know furniture is 5 years. And guess what? You bought the furniture and you have a receipt. So you don't need me to break out the furniture that the client bought. But they try and go beyond that. They try and do the whole property. And what ends up happening is, number one, you've got a report that's going to be hammered in audit. And number two, you're not going to get the amount of benefit, the legal benefit that an engineering professional will be able to find, because an accountant is not an engineer.
So I want to get personal with you. This is a heady business in cost segregation. Where do you find balance?
You broke up a little bit. Say it again. Where do you find balance? Where do you just like put it down, like put the phone down? I always tell people, hey, put your phone down and go for a walk without your phone. Right? Well, that's a great question, because I will be the first to tell everybody, for the first probably 10 years when I was involved in cost segregation, I worked like the crazy hours and weekends and traveling all over inspecting buildings. Bottom line is, now I don't anymore. Number one is, I have a staff. We have people working with me, for me. But then where I draw the line is, I try to make sure I have a great blend of off work hours. So meaning that, I told you I love movies. I love to travel. So me and my wife will travel, family, friends. We always try and keep that mixture up and not get involved in the rat race of working nights or weekends. I rarely will do it unless it's an emergency, a 911 call but I'm not a doctor, so I rarely have 911 calls. But bottom line is just keep my life balanced, my personal with my professional.
Yeah, I had a conversation recently with a guy who manages about 300 rentals. And it really was like, where do you find balance? And because a lot of times when you're in your space, my space, financial services, people really feel like you should be available for me. But on the other hand, we too have families, kids, dogs, cats, travel, et cetera, and need to have that balance. Is there a time when your phone just turns off in the day?
Nope. I'm better. I'm not cured 100%. So no, I mean,
I was checking.
I'm the leader. I'm the leader. You know, take me to your leader. I'm the leader, and
Yeah.
I basically have not gotten to the point where I feel I can turn my phone off. It's on 24/7.
Yeah.
Oh, I do turn it off when I go to a movie. Yeah.
All right. Well, I'm gonna close this out with a movie. Movie. What's the last movie that you've seen?
There was a lull the last couple of weeks, but see, look at that. Oh, I saw the one, the space movie with what's his name, Gosling. What's that called?
Brian? I don't know the name of it. I haven't
Oh,
seen it.
well, it's really good. Everybody should see it. It was really a movie that didn't have a lot of politics or anything like that. I am looking forward to, though, this weekend to see the new one about the D-Day invasion.
Oh yes, yeah.
Yeah, I think it's called Obsession. Was that the name of it? I'm not sure, but I don't know. Your listeners will know the space movie I'm talking about because it's uber popular. It's like been in the theaters for 2 months, but I don't remember the name of it.
Okay.
Great movie.
Well, folks, that's a wrap. Don't forget to like, subscribe, and stay tuned for more raw, real financial talk in the sandbox. Joe, we have gotten into the weeds here, and you have helped to explain some of this as if you were talking to a 9-year-old. And I've gotten a better understanding of it, and I'm looking forward to talking to clients, talking to potential clients and people that I work with and saying, call Joe. He's going to answer the question for you because I don't know anything about cost segregation. I'm going to stay in my lane. You need to call Joe. So, folks,
good advice.
Don't forget to like, subscribe, and stay tuned for more raw, real financial talk in the sandbox. Thanks a lot, man.